Hello friends, this is Rajesh. Today we are going to discuss about stock markets. Three things. Let's discuss on a very high level what is the stock market all about, some of the basic terminologies. Second thing is stock market a right form of investment to everyone? And third thing is more a tip. All right, let's start with the basic things. What is stock market? Let's say you wanted to have an ownership of a company, whether it's a publicly traded company or a privately held company. You invest certain amount of money, and when the company performs well, your investment grows. On the other hand, when the company is not performing well, obviously the investment will go down. So that is the kind of risk involved in stock market. Um, on an its stock market, it's categorized basically depending upon the kind of a security that's traded in. So it's important to understand the various asset classes. There are fundamentally four kind of an asset classes. The first one is equity or a common stock. The second one is fixed income securities or bond. Third one is cash equivalents, and the fourth one is alternatives. Let's go each of these things with a specific example. So equity or in stock. Let's say you invest in Amazon or a Google security, and you buy certain. Let's say you buy 100 shares of Amazon. As the company performs well, the stock value goes up, and fundamentally your portfolio value goes high. And on the other hand, when it goes down, your portfolio dips. So equity or the stock is the riskiest form of the investment or more aggressive form of investment, as it directly is proportional to how good or bad the company is doing. Historically, equity market has yielded good result, but you also need to be cognizant that it's also subject to risk depending upon the how the company performs. All right. The second one is the fixed income. So what is this fixed income? So fundamentally, a company borrows the money from the investor. Let's say you invest $10,000 in a company XYZ. What the company says is that I borrow this amount for a maturity time of 10 years. Till then, I'm going to pay a coupon or an interest. So the company XYZ borrows $10,000 from you and pays a periodic in interest in terms of a coupon for every 6 months. So you, as a benefit of you owing the money to the company, you get the interest paid, and towards the end of the maturity time, you get your principal back. So this is a kind of a safest form of investment. And though the interest rates are subject to vary, but fundamentally it guarantees you the principal. Also, you get the interest on a periodic basis. The third one is the cash equivalence. So you're conservative. You're not wanting to invest in equity or a fixed income. You invest. Rather you have the cash sitting out in the your account. This yields some paltry interest, and for which you get basic some of the basic benefits of a dollar amount. So not a great form of investment, but this is the cash or the cash equivalent which gets invested into the money market funds. You make some money. The last form of the asset class is the alternatives, which is more for a sophisticated investor. Nowadays, it's kind of available to the retail investor as well in form of various ETFs and so on. So really things like in private equity, hedge funds, real estate, some of the crazy investments, which is illiquid, meaning when you can invest in that amount and you should wait for a long time in order for it to make meaningful returns, and it cannot also be sold instantaneously because the market may not be high. So typically alternatives are considered to be for a sophisticated investor. All right, so these are the four form of various investment asset classes. And one thing to consider or understand is that the mutual funds. Mutual funds is a kind of a basket of securities, and it is not an asset class per se. It is a combination of equity funds or a fixed income funds, or it could be in combinations of the alternative funds which is traded in exchange. So mutual fund is just a basket of securities. Now we kind of dealt with the stock market and various asset class. Now let's go to our second thing on whether stock market is for everyone. It really depends upon your risk profile. So when we say risk profile, it's important to understand whether are you an aggressive investor or a moderate or an passive or a conservative investor. What is your age limit? and what is your time horizon. Let's for an example, let's take a guy who's 30 years old, and literally he's early in his career, and he has like an third I mean 30 or 40 years till his retirement. So he has a longer tenure to bounce back, to withstand any markets up and down. So he could have more equity in his allocation in his entire portfolio. And on the other hand, let's say a person who's retiring, who's like 65 or 70 years, and he can ideally he cannot invest everything in equity market because market may go up and down. To play safe, it's important to invest majority of the cash in fixed income and some of the money market security or a cash equivalent, and very less amount in equity. So it really depends upon the time horizon, risk profile, and your age limit and your immediate money needs. So equities are advised for someone who can withstand this for multi months or multi years. And in by looking back the history, equity has always yielded a good returns, but you also need to understand the time horizon. All right, going to the last component of a tip. So one famous investment kind of a theme or a saying says, it is not timing the market which is important, but time in the market is important. So what does it mean? Let's go with a specific example. Let's say you wanted to buy an Apple stock. Apple is now roughly trading around $120, and you may wanted to buy many Apple securities right now, and you may also wonder that how the future pricing it's going to be, whether it's going to go down or when it's going to go up. You may get anxious about like when to buy the securities. You cannot predict the market how it is going to be. So as long as you are convinced the security price is what, you start investing periodically. This is called average dollar cost method. So over the time, let's say you invest periodically for the next 5 years, forgetting about like how what is the market pricing. You buy the securities periodically. So if you look back and aggregate over time, the average price that you had bought the securities would be much effective than you ideally timing the market and jumping onto the securities. Yeah, and this is on a high level very tip. I know this could be lot and intense for anyone who initially looks into, but I think it's important to understand these fundamental, and as you kind of start investing in whether in equity or fixed income, it becomes very clear, and you can play by beginning with by basic investment. Nowadays, all the online brokers offers the investment account. You can play around. It is a good opportunity to invest and stand long, meaning invest for a long term in stock market. That's all we have for today. And if you like this video, give us a thumbs up and consider subscribing. Thank you.